Hello, this is Professor Catherine Close, and today we're going to talk about the sales and accounts receivable process. In my other video, I talked about how AR and AP are mirror images of each other. Basically, accounts receivable is extending credit to your customers, so you are the seller, and accounts payable is paying your vendors or your suppliers. So you are the buyer. So last time I talked about the buyer. This time I'm talking about the seller and what we see on the seller's books and looking through it through the lens of uh, accounting information systems. So if we think about it, where does the need for credit start? It starts in the marketing, sales, and delivery process, right? So we uh, facilitate business through trade accounts, right? By extending credit to each other. It can either be business to business, what we call B2B, or business to customer, B2C. Either way, by extending credit, we have increased sales. We can facilitate and conduct business more quickly. Some of you won't remember the days when you had to pay for things in advance, right? Before they could be shipped to you, or before a company would deliver them to you. So by having accounts receivable, and extending credit, we've made business faster. Now, when we talk about accounts receivable on the book, we're talking about companies that issue, extend their own credit or have their own credit cards and allow customer to pay it, say, in 30 days or 45 days. We're not talking about Visa or American Express or MasterCard. We're talking about companies that have their own. So in the day, that used to be something like Sears or J.C. Penney's. It may now maybe Macy's or Target, right? So they're running their own credit departments in these corporations. So when we look, we start with marketing. Marketing is our unit that connects products to our potential customers, and they work together to sell, create contracts, negotiate terms. When we're establishing credit for our customers, they'll often fill out a short application. We'll do a credit check on them, and then we'll give them limits and terms, or when we talk about how many days to pay, or if you pay early, for example, 210, if you pay within 10 days, you'll get a 2% discount on the entire invoice. If not, you don't get any, you need to pay in 30 and you don't get any discount. So these are all the things that might happen in our marketing and contracting department. For sales, some sales are immediate. You'll always hear me talk about TJ Maxx. You walk up to the counter at TJ Maxx and you purchase. You pay with cash, or you pay with a TJ Maxx credit card, right? So here you're going to walk away with it. Other times, goods have to be delivered. And then if you remember back to your 221 days, so here, if you remember back to your initial studies, we were concerned about who was paying the freight, right? And things of that nature. But the bottom line is we record the sale, and then the credit is outstanding, and we rely on our accounts receivable unit to collect the cash from the customer. So once again, accounts receivable is one of those subsidiary ledgers that many of us will begin our careers in. That's where I began my career, was in the credit area, the accounts receivable area. So along this chain, or process chain, so along this process chain of marketing, sales, and delivery, we're going to have risks. And that's something we've looked at, right? So in marketing and pricing, right, we might have loss of leads or financial losses. We might have somebody break into our marketing database where we could lose data. We might have poor marketing materials that you really don't explain things well to the customer and result in conflicts that maybe the customer will later dispute the sale or dispute the price and not want to pay. We have customer fatigue, right? How many of you are always getting flyers for the same thing, right? That can actually have an adverse effect on the product's appeal. Within our operations, collusion, right? Where between employer and a buyer on the price. Once again, we mentioned this in accounts payable, kickbacks, right? This is the opposite side of it, right? So this is the seller or an employee conducting fraud. Unauthorized customer discounts. So something that goes against the company policy. You're going to give a bigger discount to a friend. No, that can't happen. Pricing pressures from customers. So some customers are very strong negotiators. Certain industries, there's no negotiation. You don't go into a big box store and negotiate the price of a product. But when you're dealing with contracts, you're dealing with services, or you're dealing with larger equipment in a very competitive environment, this negotiation and marketing and pricing are big deals and can be very risky. In terms of extending credit, right? This is why we have to have good processes in place. That we still can check credit histories, credit scores, right? We want to check on that. So right now, one of the most common things that I think is different than in my day in credit, somebody had to come to the department, fill out a 1 or 2 page application, whether this was a business or an individual customer. And we would then run this. It would take a couple days, and then we would extend the credit, and whether it just be an issue a card if they needed a card or an account number. Today, you'll notice that a lot of stores will allow you to fill out a very small application, and they are issuing you credit immediately because they're taking the guarantee of a national credit card, like a Visa, MasterCard, or American Express. So credit risk, though, the risk of bad debt is always a problem. Um, and customers who maybe can't pay or won't pay. You can have reputational risk around offering credit, right? If you do things like charge different prices for the same product to different customers. So even in this ability to do individual negotiation in some industries, if you get a reputation for having bias or you know, um, erratic pricing, you're not in a kind of what I would call a relevant range of pricing, this can damage the company's reputation. And um, disputes over contracts, right? A verbal agreement can be legally binding, but in certain industries, you better be creating a formal contract. One of the biggest things in the area of accounts receivable is when we end up with fictitious customers, right? Or we have, or when we have internal fraud, for example, the accounts receivable person is, the other area is this area of how payments are applied, right? So when you hear about embezzlement schemes and things like that, it's often the idea that the customer pays, but then the accounts receivable clerk uh, is able to divert the payment and actually cash the check that the customer sends, deposit into their own account, but take these funds. And there's very formal names to these schemes, and you'll learn about them more in auditing. But once again, if you get down to these risks, right, what do they relate to? Segregation of duties. How do you prevent this? How do you control this, right? You can't have the same person making the sale, producing the invoice, right? Accepting the payment, making the bank deposit. This is going to lead to opportunities for fraud. We talk about shipping too. The last part, um, or part of this, the last part is making sure the customer gets the product, right? So if we have aren't shipping to the right address, or somebody is hijacking our deliveries, or we're not shipping the right quantities or the right products, this is going to be problematic. Once again, accounts receivable relies on documentation, right? So documentation that we've established credit with the customer. We've produced a sales order. So marketing is often going to be producing a sales order. Marketing is responsible for documenting what the customer wants and the price. This is fed into the information system. It should then result in what we call a picking request. If it's inventory, this means inventory that the customer does not have immediate access to, like you do in a retail store. So somebody has to go back to the stock room, pick the item. They might have to recover it from an actual warehouse, right? They then have to prepare a packing slip and then they have to deliver it. So think about the processes that we learned in accounts payable. These are the mirror image for the vendor who is selling, right? So it's all this documentation is approval, right? The sales order, we're approving the sale. Especially when you're in these contracts where you're doing negotiating some pricing, you're going to have a sales manager or even somebody above a sales manager signing off on the pricing agreement so that we know that there is support for the price that was offered to the customer. The picking slip is so important because it gives authorization to remove items from inventory. And it's key, then that's going to be part of the reconciliation process of inventory, right? It also kind of is the permission to pick from inventory, then supports the packing slip, which supports delivery, which then allows us to invoice the customer. So we really have to be sensitive again to documentation within the organization. Some organizations still run on paper for these operations. Other tablets. You'll see a lot of use of tablets now in different businesses, but they're sending these forms electronically. So all this is still in place in a very formal way that sits within our accounting information system. If we look at the example here that deals with the cookie case that we're studying, right, we see that there is a difference, as I mentioned earlier, whether a customer is picking something up in the store at a cash register versus if it is an order on a mobile application, on the internet, or if it's something that has to be pulled from a warehouse and go through an entire delivery process. So understanding what your company does, right? Also understanding that they can be doing multiple ways of delivery, right? It can be in store face to face. Nowadays, it's very common to go into the store and then they say, oh, we don't have it, but I can get it to you from another location, or I can order it online for you. So these are going to have subtle different processes in place to complete the order. So once we've taken the order and the customer has the merchandise or has the product itself, right? We're going to say, okay, I can extend you credit. And when we extend credit, we've gone through the company's formal processes to make sure that it's okay. And then we're going to invoice. And if we have to invoice them, right? So if it's an immediately what we call a point of sale, we're going to hand them a receipt immediately. But if we have to go through the process of invoicing them, right? We are going to have to know more about them. And this gets to the idea of accounts receivable has a data set of records below it, so to speak, right? Accounts receivable is the control account, and underneath it are all these individual accounts receivables, right? The records for all of the customers or clients that we're invoicing. So we need to make sure that we're charging them the right amount, right? We're sending it to the right address. We're putting the correct terms on it. And when they're paying back to us, we want to make sure that we're applying the payment to the correct account, right? And that we're not getting complaints from customers about you didn't record my payment or things of that nature. AR deals not only with invoices, which are essentially receipts, right? But they also deal with statements. So some companies will still send out a monthly statement that summarizes all the purchases and then gives payment terms, explains credit limits, and reminds the customer of all of what they've committed to in terms of paying. We might also, just like we talked about in accounts payable, customers may be given incentives to pay early. So terms, right? 2-10-30. A 2-10-30 is telling the customer, if you pay in 10 days, I'll give you a 2% discount. If you can't pay in 10 days, you have to pay the full amount in 30. This is to incentivize the customer to pay as early as possible. And why do we want to do that? Because we always want to keep cash flow going, right? The thing with accounts receivable, we talk about turnover, or average collection period, right? How quickly can you get that cash back in? Because the thing I always remind everyone of is that if the corporation is extending credit to their customers, it may actually have to borrow for its operating expenses while it's waiting for its money. So this is why we give incentives to collect money more quickly. If we can get the money in more quickly, we can pay down our borrowing and we can lower our interest rate. This is why accounts receivable management and jobs in that area are so valued, because just like the AP manager, the AR manager is measured and evaluated by how fast they can turn over those collections, how much that they can get in. So this then is a very big area of accounting. AR is part of the general ledger, right? Typically, we want to be looking at current business analytics information on how things are going. So if we're going to talk about in future classes dashboards, right? Dashboards are graphical presentations of important performance metrics for different areas. So if you remember back to ratio analysis, this is going to be visualizing AR ratios so that management and others can follow them. So I think the key things to take away here with AR is permissions, once again, approvals, they're still there. They're just kind of in a different form. Manager approves credit to this customer. Controls to evaluate credit worthiness, controls to evaluate correctness in terms of handling customer accounts, and segregation of duties. I don't think we can ever talk about that enough. I will say though, that is a challenge for many small businesses. And they don't have enough personnel to segregate the duties. So that is something to think about. Management usually has to play a active role in monitoring when you have somebody who is going across all these processes. So we should always be looking, not to have the person who creates the sale, produce the invoice, collect the payment, and go to the bank. So the next time we meet, we are going to talk about the general ledger.